everyone has more time on their hands right now on the admin side and the risk side. And I'm seeing a lot more of these notices come out, even on bridge loans. Even if you're talking about
Yeah.
bridge loans, the same thing. Everyone has too much time. They're starting to deny certain exceptions. They're starting to take away certain rights. Like, this is
Yeah.
all a part of the process. They're getting more risk averse as we go.
Folks, did you know it's impossible to get an investor loan conventionally with 20% down today? Did you know you could get a DSCR loan with only 20% down? Did you know that might come with something in the low sevens? This is a product that undoubtedly has taken off recently. If you have a little bit more scratch and you want to put 25% down or more, I'm hearing that you could get something with a 6 handle on it. These are investor loans, folks. Getting conventional done today is hard. They are looking at them with a lot more details. Maybe, just maybe, DSCR is right for you. But hey, let's talk to Jonathan from Convoy Home Loans and get the skinny on what is going on today. How you doing, buddy?
I'm all right. I'm all right. We've been super excited, obviously, with the recent market changes on making sure you're getting more deals to work. I think that's the biggest thing right now. And the 20% down impossibility is for 2 to 4 unit or multifamily in the conventional space, right? Because
Correct.
that's just you're just not allowed to do that, right? They don't
Yep.
offer it.
Yeah,
And we've talked.
the minimum conventional is 25, just to add clarity to that.
Correct. A single family residence is actually 20, but multifamily is
Multi.
25. Yeah.
Perfect.
So the reason why that's such a big deal is obviously in lower cost states like Ohio or Michigan or Idaho, like those places where the cost of like a 3 to 4 unit is, let's say, 150, 200, 250. The 5% difference may not seem a lot, but if you're talking about cash on cash return, that
Oh, yeah.
5% difference is actually a big deal just because the return on that property is not you're not buying it for the appreciation, so you have to calculate purely on the cash flow. And if you're doing that 5% off, which means that instead of putting 25% down on a conventional loan on a 3 to 4 unit, you put 20, you save that 5%, you can reapply it somewhere else or use that to make repairs on the property. And on top of that, right now, like we have a bunch of loans in right now, a 3 to 4 unit in those same markets at 7.1, 7.2, 7%, 6.99
Wow.
with 20% down. So it's like
That's
right now in
crazy.
this moment, yeah, I know. In this moment, it's more of a situation of how are you going to maximize your cash on cash return? I think that's the biggest thing.
Well, that's great because that's what I talk about in my course, How to Get Started One Rental at a Time. It's all about yield. We'll go over it very simply here. Basically, it's just a formula. The bottom number, right? The denominator is down payment, in this case, 20%. Make ready, right? What does it take to get the units turned so they rent at market? And then 3 closing costs. And oh, by the way, in today's market, you could get the seller to pay 2 points of closing costs. So why not ask for it? And then just to close out the formula, the top number is the expected yearly cash flow. And the beauty of this calculation, if you're doing it correctly, is you can get what's called positive carry. What is that? Let's just say the unit in Ohio is producing a yield of 12%. Well, if the debt is, let's say, 7% for round numbers, actually putting less down drives the yield up. It's called positive carry. So this is really understanding what's going on. What's the best use of capital? A lot of us, come into this Navy with not a lot of capital. So that extra 5% that you can redeploy on make ready, you can get the seller to give you closing costs. Dude, it's just the master stroke of how to get a great deal today. So it's pretty awesome.
Yeah, and obviously, like we opened up with earlier, if you want to put more down, then it's even better, right? I
Right.
mean, the number of clients that I'm having right now do 25, 30% down, but then buy it down to like 6.1 is like is a lot
Wow.
because
Now,
at
so
that.
hold on. You're hurting my head. So you're having investors put a little bit more down, say 30%, probably have good credit, probably have reserves, and buy it down to something like 6.1. Did I just 6.1 30-year fixed?
Yeah, 30-year fix. Today, I mean, yesterday we actually locked and closed one. They bought it down 3 points, but it was 6.08. So on a 30-year fixed, with 25% down.
You know why
So
that's so important for investors? This is important to understand because if you get 6.08, I suspect the chances that you're going to refi that loan in any meaningful way in the next several years is almost zero,
Yep.
right? You're not going to refi that at 5 3/4. It's just not worth it. So you're sticking on debt that really puts you out on the risk curve, really controls the risk of having, an opportunity. Dude, I didn't think you could get an investment loan in the low sixes. That's crazy.
I mean, you're talking, that's almost like, conventional. Obviously there's pros and cons to it, but if you're talking about getting down in there, I mean, it's almost cheaper than conventional, right? And on top of that, if you're doing that, like you said, you're not going to refi for anything that's even 1% or 0.5%, whatever, less, because it doesn't make sense on the monthly payment savings. But you just need to think about it as like, yes, it's more costly right now and it may suck right now, but again, what I always try to remind people is this loan program, is the DSCR program going to be around forever? Is there a history of it forever? There's not, right? We don't know where it's going to be. We've seen
Yep.
it in the last 3 years. If you go back on our videos, we talk about multiple times about, oh, it was almost gone. Like we were the last ones to, like we've talked about that before, but obviously human nature, we have a bad short-term memory on bad memories, I think it is,
Yeah.
right? Yeah.
Yeah. Yeah.
And so we don't remember pain as well, so we go through the same thing, could go through the same pain. But what I'm trying to tell clients right now is like, this is one of the rare opportunities where, yes, you might have to pay a little more in points, but this is an opportunity where you can lock something in and not have to worry about it for the entire 30 years
Yeah.
and
Just
just
let it
pay it
run.
off. And if you want to let it pay it off, and if for some reason conventional investment loans come back to being in 2 to 3%, 4%, then you can refi into that.
Yeah.
But even in the heyday, when we were talking about 3 years ago, 3.5 years ago, 4 years ago, when the conventional rates were 1 and 2 and 3, like investment loans were still 4
Yeah.
5. Like,
Exactly.
so it's not like you're missing out on anything. So you just need to factor that into the long-term view if you have a long-term view. If you have a short-term view, obviously it might not be the best option for you. But for people that are trying to take this long-term and want to take it to the end, this is a great opportunity to
Yeah.
maximize your
It's crazy.
cash flow right now, because it's fixed debt. So it's something you can calculate the return on going forward, because your payments not going to go that much higher besides tax and insurance, but your rents will historically go higher every single
Yep.
year, right?
Inflation's a feature, not a bug. Yeah, I think getting down to the low sixes is a genius move if you can, because you really do take that refi risk away, right? At some point it makes sense, but are we really going to go back to 4% mortgages? I hope not. That means the economy is in a really bad place. But yeah, it's crazy to think about. I know the last couple of weeks, I've been talking to lots of lenders, yourself included, about conventional and just how picky Fannie and Freddie is getting when they look at files. Um, there's just it's harder than it used to be. Is that still true?
Absolutely. I mean, the number of I think conditions that I'm getting on conventional, because we still do a lot of conventional as well,
Yeah,
VA, FHA. Like these underwriters are getting so nitty gritty, picky with every single detail on the loans. Like things that would have just passed by 2 years ago are like now being scrutinized, and then they're coming back later and being like, hey, post close condition, now we give us this, give us that, and the borrower's like, bro, we already closed, like we're
yeah, I already
done,
got
like
the
what?
cash, buddy.
Yeah, what's good? What do you mean? So that's been happening a lot, and obviously a big portion of it is because I think Fannie and Freddie, again, everyone, they just have too much time on their hands because
Yeah,
volume isn't
that's
as high, right?
exactly right. They have the
Yeah.
same number of employees. They got to find something to do, and right now they're auditing and kicking back loans. It's
So
comical to think about.
what's actually been, and this is kind of scary for the people that have done conventional loans but flipped it over to their LLCs, which technically you're not supposed to, right? In the
Yeah,
technical
it's a
sense, right?
different entity. Yeah,
Like
yeah.
they I've been seeing more, actually, people call me and say that they're in a post-close audit because of that. Which is actually, I didn't see it much until like recently, right?
Right.
Because up until now, like people, whatever, you put it in LLC,
Yeah.
whatever, they just title. But people are actually, obviously, when you do that on a conventional loan, this is another plus to DSCR. If you know you're going to put it into LLC, right? It costs a little more, but whatever, it's worth the longer term play. But if you're talking about conventional and you do, let's say, put into an LLC later, that technically makes your loan, right, package, which was written under your name. You're not supposed
Yeah.
to technically change
Yeah,
title.
it's
And if you
mortgage
change
fraud.
title,
It could be
yeah,
seen with mortgage fraud.
exactly. And you have to tell technically everybody that you're
Oh
doing
yeah.
these changes. And I've seen it with my own eyes of notices that clients have gotten of like,
Yeah.
hey, we've noticed on title that you changed the ownership and you did not notify us. We are going to start the process of basically calling your note,
Yeah.
which
Yeah.
is
Again, yeah.
scary.
Well, I mean, yeah, I mean, I would be transferring that title back ASAP to
Yeah.
get around that. But yeah, folks,
It,
this
yeah.
this is banks don't play, right? And I think Fannie and Freddie and lots of services out there have more time on their hand. Their employee, let's just be real, their employees are trying to find work to do because the loan business is down. And this is deemed good work because they're protecting the borrower, right? The entity that was approved for the loan is not the LLC. So of course they, frankly, they have the right to call the loan, in my opinion.
Yeah, I mean it's in the docs, right? If
Yeah,
in the million page Bible of documents that you sign, in there it states that you're not you will notify about transfers of title and ownership and all that. It's just it's in the docs. So I'm not saying it'll be an issue, but like what I have seen before, and these people that are buying subject to as well. I mean, I don't know. Again, I'm not going to say it's going to happen. I'm not going to put that into the universe, but
right.
I'm just like people have more time now and these entities have more time, servicers have more time. I'm seeing this happen more. I'm seeing cities like even like assess values quicker than ever before too. So
Yeah,
which is property taxes going up. Like everyone has more time on their hands right now on the admin side and the risk side. And I'm seeing a lot more of these notices come out, even on bridge loans. Even if you're talking about
yeah.
bridge loans, the same thing. Everyone has too much time. They're starting to deny certain exceptions. They're starting to take away certain rights. Like, this is
Yeah.
all a part of the process. They're getting more risk averse as we go.
But that's exactly what's happening. They're getting more risk averse. Also, it would not shock me if we just being honest with each other, Jonathan, if they're using AI tools to kind of highlight potential problems that need to be investigated, right? It's not hard to think about AI being trained. Hey, go look at the closing doc. Hey, go look at a current title. Has there been a transfer? Oh, flag that for some human being to go send a note. It would not shock me if you can automate that with AI in some relatively easy fashion.
I think the mortgage industry luckily is a little more archaic than I
Oh,
think
good.
we think. But I mean I don't see that not being foreseeable like near term future, obviously.
Okay.
But this is just for the listeners and for
Yeah.
investors, right? Just if you do things the right way, right?
Yeah.
And that means if you're gonna buy it in LLC, the lender is okay buying it in LLC, and this is like the whole thing, there's no problems with it,
Yeah.
then you're okay. You're covered. You're not going to have any problems. This is only for if you're buying in conventional because you want to get a lower rate, lower cost, whatever, and then you flip it over to LLC, which technically on the docs is not, kosher with them.
Not good. Yeah.
Yeah,
Exactly.
so that is where the issue comes with, okay, you might get into a problem, but again, this is not raising alarms. This is just
Yeah.
I just saw
Oh
a few
yeah.
letters. So I'm just putting it out there like, hey, warning, if this is happening, like just make sure that you're, dotting your T or dotting your I's and crossing your T's on everything, making sure that you're clean,
Yeah.
because this is starting to happen.
No, I think that's very wise advice. And again, this just might be another reason, folks, go DSCR. Just go DSCR. Jonathan, if somebody wanted to reach out to you and see what's right for them in their situation, they want to work with you or your partner, Dustin, how do they reach out to Convoy Home Loans?
Go to convoyhomeloans.com and let us know you came from ORaaT.
Dude, let them know you came from ORaaT. You get this fine gentleman or his partner, Dustin. They're going to listen. They're going to give you advice. Is it DSCR with some points at 6-1 right? Is it conventional? These guys will tell you the truth. And hey, the other thing they do, if it's not a deal, they're going to tell you it's not a deal because negative cash flow, alligators, bad. Jonathan, you're amazing. Thanks, buddy.
Thank you.